final panel of the day, which is going to be on enabling an ecosystem for Impact NBFCs through a policy and institutional support. The discussion will focus on building collaboration among different stakeholders to strengthen India's financial inclusion agenda by supporting Impact NBFCs. The panel will be moderated by Mr. Royston Braganza, CEO of Grameen Capital, and he will be joined by Ms. Deepti George, Deputy Executive Director and Head of Strategy at Dvara Research, Ms. Nethra Bhat, Director and Senior Investment Officer at Accion International, and Mr. Ishpreet Gandhi, Founder, Stride Ventures and Stride One. Thank you all for joining us today. And now I would like to hand it over to Royston to begin the panel discussions.
So at the very outset, thanks for the earlier moderators who've been able to squeeze some time back onto the amount of time available to us. But I do want to congratulate the IIC and the partners for this amazing report. I think we are seeing probably a new wave, and I know a new wave is not a good terminology to use in the context we've been used to for the last 2 years. But probably we're seeing a new impact wave. I think what we saw in microfinance about 15 years ago, we are seeing currently in terms of the ESG, SDG impact space. And the role of debt is going to be significantly critical in growing out that impact ecosystem. So, we have 3 great panelists. What I'm going to do is quickly maybe give them a minute or so to introduce themselves and give us perspectives from which they're going to come at it today. But I do want to overlay this with clearly what seems to be resonated from the earlier panels. The fact that microfinance has demonstrated the ability to show depth, the ability to show returns, the ability to show impact. And one of the things we don't want to do is to throw out the baby with the bathwater and say, let's create a completely new Impact NBFC world. What has worked there? How do we replicate those? What didn't work there? How do we keep them aside? What's working in other sectors, whether it's technology or clean energy? How do we bring that into this ecosystem? And then create what we think could be an enabling ecosystem for impact debt. So with that, maybe Ishpreet, can I ask you to a quick intro and the perspective, and then Deepti, and then Nethra.
Sure. Thank you, IIC, for inviting me to this panel, and thanks, Royston, for setting the context. Stride, quick background about us. We're better known for venture debt funds of ours. We run 2 funds with an AUM of $250 million in venture debt. But what we've realized is that startup ecosystem is generating significant inclusion across economy, with new age companies being active. So we believe 5 to 6% of the Indian economy will come from the employment created by the startups in the country. This can be in the form of day-to-day consumption, which we see in the form of Zomato, Swiggy drivers, or logistics, agri-tech farmers, MSME, which is getting inclusive under B2B commerce. So Stride One is an initiative which got formed last year, which is an NBFC funding these new age companies, partners, and getting them into the formal economy. So I'll be giving that perspective today in terms of how we believe that NBFC's capital can be really significantly increased over a period of time through various manner. And so that's a quick background for Stride. Thanks.
Awesome. Thank you so much.
Hi, everybody, and thank you, IIC, for having me at this panel, and congratulations on a very, very important report. I think the whole sector really can do with a lot of data-driven insights, and this is actually one big contribution. So I am Deputy ED and Head of Strategy at Dvara Research. We are a financial sector and financial inclusion policy, research and advocacy focused organization. We are a non-profit based in India. I think really over the past 14 to 15 years, we have been, among other things, we have been sort of working towards and also thinking about financial systems design and how the interactions and partnerships that regulations enable between banks and NBFCs and all of the other participants in the ecosystem has been very dear to us. We have been contributors to various sort of RBI-led committees in the past. And also interestingly, we've sort of been the writing secretariat for the SEBI's working group on the social stock exchange. So I think this is a panel which kind of blends together both financial systems design as well as impact, and so it's very important for some of the work that we've done.
Awesome.
Hi, thanks, Royston. So just quickly introducing myself, Nethra, I look at investments for Accion Global Investments. I lead investment evaluation and portfolio management for Asia. And I'm also leading impact measurement and ESG evaluation for the investments we make. A quick background about Accion. Accion has been in the financial inclusion space for almost 60 plus years now. In terms of what we offer, in addition to making investments in emerging markets, very much focused on the financial inclusion space, and also supporting funds that make investments in this space. We also look at providing advisory on risk management, digitization, and also looking at sharing think tank report, also providing reports on the financial inclusion and client protection and everything that comes with it. So here today I will be providing perspective on Accion's role in investing in the financial inclusion space. Thank you.
Thank you. By way of introductions, I mean, I represent Grameen Impact on this call, and it is an NBFC focused on the impact space. In the formation of IIC, probably for the first 2 terms, I was the only debt-related person in the IIT executive committee and the board. And I think for me, therefore, it's a moment of great joy to see this report so brilliantly produced. But more importantly, talking to the very specific ecosystem that needs to be built out. Mr. Vishwanathan is still on this call. I can see him, but he so well articulated the role that RBI played. And Deepti, you're going to talk about how RBI and both the government as well have a role to play. So I want to just lay out 3 or 4 big parts, and then I'm going to maybe first go to Nethra. I think one of the big things that happened, to really scale microfinance was access to priority sector debt. It was access to be able to get ECBs, the creation of an NBFC MFI category, the ability to look at even grant pools of capital, technical assistance. I mean, these played a significant role. We seem to have forgotten some of those pieces, and we are sort of launching into NBFCs, with very high ROE, ROI expectations, but not realizing that the microfinance sector had a significant scale process that included grant funding, that included technical assistance, that included guarantees. So are we missing a trick or two in this race to try and suddenly, show phenomenal growth? Is there something that, from your experience in Accion, you want to share with us?
So yeah, thanks for the question. So I think one of, if you see the early investments that we have made in Accion is really, providing exactly what you said, the financial support in transforming NGOs to commercially viable business models. And I think there the support is capital aside, also providing assistance in providing guidance on what it takes to transform into a commercially viable kind of a business model. In that sense, I think we've been very focused on identifying, kind of pretty much customizing our approach on how we work with financial institutions. Most recently, I think pandemic is always an example that all of us quote, but what we've also seen is we really saw that NBFCs looking at digitization being a very urgent need for them as they thought about scale and as they were looking at dealing with new kind of market shocks. But keeping really in mind what is an NBFC, what does an NBFC require early stage? We're talking about providing early stage capital in terms of through the different funds we've looked at. And even through our advisory model, what we've done is we've reached out to large, financial service providers to provide the technical assistance support to help drive the strategy of maybe digitization or risk management, however we want to identify. So I think it's really about engaging the ecosystem based on the requirement of these NBFCs is what we have been working on over the past decades, I would say.
Thank you so much for that, Nethra. Ishpreet, I think one of the areas that we've seen in the ability to build scale, and while a lot of credit is of course taken by equity investors who came in early in microfinance, probably the biggest switch that got flipped was putting microfinance within priority sector lending. The ability for commercial banks to come in a big way to be able to leverage, to create that type of scale and allow NBFC MFIs to really grow. Today, co-lending probably is an opportunity that could be looked at in the same ilk. Maybe you could talk us through a little more about co-lending and any other type of new pools of debt that would be opening up to the Impact NBFCs that we could learn from, grow from, and take it to the next level.
Sure. So Royston, if you largely see the landscape, I think while we always would have apprehensions in terms of how the NBFCs are getting support from the banks, especially the smaller ones, I think the right, and we would naturally want to differentiate between some of them which are tech-oriented and non-tech oriented. But I think that the ways and means to build it can be very interesting. And that's where things like, as you said, maybe microfinancing in cluster-based or embedded finance comes in. And if structured well, I think the banks have started, since I'm an ex-banker and have led some of these transactions, I think banks have started looking at it in a more positive manner. So they also want to create an end. They also want to ensure that there is as much inclusion as possible through priority sector lending. But I think on balance sheet is something which has kept reservations, seeing the macro scenarios, seeing the current scenarios, what we are in. And I don't think it has stabilized to an extent to start giving confidence back. So the way we've seen it and the way the banks speak about it is how we can channelize using the strength of those NBFCs, their ability to origin, their ability to maneuver, their ability to understand risk better than some of the traditional folks and share that risk in some manner till the time they're not getting as much balance sheet support as they require. So one way is naturally to augment it in a manner in which the leveraging is best for the NBFC to do it. But the second way, I think, what you mentioned is a co-lending way, in which while the regulations have evolved on co-lending as well, but if the risk participation is done in a manner in which it fits the eye of the bank, there are FLDG structures, which is first loss deficiency guarantee structures. There are direct pass-through structures. Some of the NBFC have started looking at doing KYC on tech, very basic minimal tech, but ensuring that the routes are covered well. That can give a lot of comforts to the bank for larger participation. And we see a lot of desire for the banks to do it. So I think that's another step in direction which can really be taken by some of the NBFCs as they struggle to leverage in the manner in which they want. And at the same time, giving confidence of the bank to the banks that this can be built in a manner in which you can, over a period of time, start taking on balance sheet calls. So I think that's a trend which we've seen across financial services sector. And at the same time, banks are pretty much open to look at those stance.
Thank you so much, Ishpreet. One of the things that, listening to you, Ishpreet, we seem to be, also not looking at the other opportunities that are there, and we seem to be linked only to RBI, and probably a good time to pull in, Deepti into the conversation. Deepti, are we missing something that is unique to an Impact NBFC? Our conversation, the discourse seems to be more NBFC and less Impact. And I'm not saying that, in any negative fashion. I've enjoyed the conversation so far and the discourse so far, but we seem to be moving quicker to NBFC and lesser to Impact. That may be the right way forward, that may not. And so I'd love to hear your thoughts. And are we needing to probably engage the government more and RBI less, RBI more, government less, or engage both? Maybe your thoughts there.
Yeah, no, great question, Royston. So I think let me just perhaps just take a step back and say, who are these entities, right? They are, of course, in the definition that's used in the report, in the IIC report, is really NBFCs with asset size lesser than 500 crores and significant customer base from the BOP segment. I would say that, okay, these are really NBFCs that are in what you would fix as the base layer in today's RBI's conception of the scale-based framework for regulation, right? And I think we should also just understand that, there are larger NBFCs also who are creating an impact, who are operating in the BOP segments, right? We are really talking of smaller entities, and the question is, why do we need them? What is the specific role that they're playing? And it's not just, the answer is not just that we need a pipeline of NBFCs who can then become large, right? And because they are serving the credit needs of the economy. It's much beyond that, right? It's about NBFC being an entity that also wants to survive, with its inherent strengths and weaknesses among the ecosystem of corporates out there and the various sectors out there, right? Deciding they have freedoms to choose where they want to operate. So I think in the conceptualization of the financial system itself, we are thinking of banks as being the sort of the low risk core. They have to necessarily be low risk balance sheets, right? And we have NBFCs who are really in the periphery. And I'm not talking of all NBFCs, but really the last mile NBFCs are the last mile for transmission of monetary policy, for example, right? And so that's where they are the kind of the channel through which the banking system is able to touch the lives of, let's say, low income, whoever it is that we're talking of as being the BOP segment. And so they are not low risk. So they are necessarily engaging in risky lending because we don't know what these segments are, asset classes are. And so that's the specific and unique role that they're playing. And so it's important to make sure that there is no, particular additional disadvantage that they are experiencing in addition to what the sector itself is experiencing, right? And not just as an aftermath of the pandemic, but also from kind of regulatory approaches, etc. So I think in that context, I think clearly there's that perception issue that has continued. That yes, I think the report also alludes to it in its first line, saying these are shadow banks, and so there is some by default something negative associated with it. So we can have to shed that. Shed that issue. But the second being that there has been significant regulatory statements and clarity and positions over the past 10 years or more when we think of microfinance or HFCs, right, or housing finance. So all of the other NBFCs outside of it really haven't had that kind of regulatory clarity, and so I suppose the investor ecosystem is also viewing them as there's this loose body of entities who could get regulated, so it's a kind of like a regulatory gray area in terms of when they might be subject to something. The other thing is really, there is also greater clarity on the middle layer NBFCs onwards, and we are still talking of base layer, right? So I think one way to fix this, or rather one big reason for this, I would contend, for both these issues is that there is a lack of information with the regulator about the activities of these entities. Obviously, they are tiny, so we are not saying over-regulate them or ask them to start reporting significantly to the regulator. But particularly on this whole function of just credit market monitoring, we need a way to make sure that such entities are also part of sort of the ability of the RBI to monitor credit markets. Where are these disbursements going to? Which regions, which segments, subsectors, right? And so if we want to build some kind of an early warning system, then RBI is much more comfortable in having a whole bunch of these entities out there who they're not very clued in on what they're doing, and that's fine. We're comfortable with not knowing information, but we are at least knowing what their activities are. So that may be one, so I think, let me just stop there. I think your question on are there more impact producers rather than just being NBFCs and doing lending? I don't think we can split those into two separate buckets. It is possible to have business models that can generate impact while also being for profit, right? I think that's the we have to kind of accept that it's not necessarily a different animal. So let me just stop there. I hope I've answered your question.
You did, but I just want to clarify a part of that question. So I'm not saying we need to split the impact in the NBFC, but I'm saying in that endeavor to get the right enabling policy, we seem to be latching on more to the NBFC suffix rather than the impact prefix. and therefore constrained with our engagement with RBI and probably not enough with government. And the reason I'm saying that is sort of the flag behind me, which I stole from the United Nations when I addressed the General Assembly a couple of years ago, the year before COVID. So it brings to mind the fact that $30 trillion is needed to finance the SDGs. India needs a significant chunk of that. So the fact that it is commercially viable, it needs scale is undeniable. So let's sort of, that's a given. But if G20 is coming to India after Indonesia, Prime Minister Modi is keen on SDGs, Niti Aayog and Amitabh Kant, Rajiv are recategorizing all of the aspirational district work within the SDGs, we're suddenly seeing a lot more momentum, a lot more support, a lot more allies beyond the traditional RBI and the MOF. And I don't know whether we are taking enough of support and therefore really to IIC and Ramraj and team, I love this topic, creating an enabling ecosystem. So the ecosystem is much broader than just getting in capital. Can the Ministry of Health become an outcome funder for a health NBFC? Can the Ministry of Sanitation become an outcome funder for a water and toilet funding, sanitation financing NBFC? Can Ministry of Livelihood become an impact funder for a vocation skilling NBFC? So those are the things that we at Grameen Impact have been able to do by creating our SDG impact bonds, where we said, can we create debt products that are able to exercise much more than just commercial pools of capital, but can we excite CSR? Can we excite ministry corporates? And I think that is really the ecosystem. So I want to come back to you, Nethra, because Accion was someone who did this really well in the early days of microfinance, but it didn't do it alone. There was Unitas Capital, Grameen Capital, IntelliCap, which were doing, say, advisory. There was MCRIL, which was doing rating. There was M2I, which was doing consulting. There were lots of people in the ecosystem that helped an MFI to succeed. Those are not helping an Impact NBFC to succeed today. We don't have that. People either want to show we have an NBFC, we won't talk to anyone else, otherwise we'll be seen as less commercial. And I'm worried, because I'm worried that, the whole heart of this, and, Raman of SIDBI said this clearly in his opening comments. He says, what is the specific definition of an Impact NBFC? Are we trying to be all things to all people? Are we missing something? So Nethra, what do you think we should be looking at? What would Accion look at if it was to invest in an Impact NBFC?
I think, so just to kind of take a step back, when you're right, I mean, there is this fear of being bucketed as a social enterprise, and how do I attract capital if I'm not going to be able to show some kind of a profitable model? But I think the way we have looked at business models is one, really, I think the financial inclusion impact thesis is something that we've always been very clear about. So the advantage that we have is we also have the ability to invest directly from our balance sheet. And so in my mind, there is availability of patient capital in kind of thinking through what is it that works for an institution like this to help them transform, to your point on making it scalable. Now, obviously, we have to take a decision of whether they're going to be better off staying as an NGO. And so do we have that flexibility to invest in a not-for-profit kind of a legal entity, and maybe they don't have to transform to a for-profit right now, but maybe in 3 or 4 years, right? And in addition to that, I think it's basically really just understanding where that institution is and how can we kind of help them to get to that scale. I think there tends to be restrictions when you're looking at it from a fund standpoint, right? Because you have to talk about returns, you have to talk about scale, you have to talk about future rounds and all of it. So, but I think it's the availability of different capital structures to help these Impact NBFCs. And I agree, and I think this is a point that that Deepti also raised. And it's not that every it's, for example, a lot of when we talk about Impact NBFCs, they have a different set of, they have a there are some institutions where, for example, they're very much constrained by the markets that they're looking at. We're talking about tier 3, tier 4, maybe the poorer states of India, looking at Northeast region. And that's a very different challenge. And you're not going to be able to see that kind of scale. So the other way to look at it is, okay, how can you leverage, maybe say, can you leverage a fintech partnership to try and, expand your business in other states, but being very, very focused on your customer segment here, using a feet on street kind of a model. So those kind of things, I agree. I think there are different types of impact in NBFCs. They all come with very interesting models, and there are these case studies that I'm seeing here, and how they're really creating impact, whether it is through the technical assistance that I saw in one of the case studies. How are they really creating impact for their end customer? I think these are things that we are seeing, and I think we all have a role to play, like you said, as part of the ecosystem to kind of help them get to that vision.
Thanks for that, Nethra. Ishpreet, I want to sort of change completely track and move to the other extreme and say, what is it that the fast-paced world of investing today is offering Impact NBFCs? So what's changing on the technology side, on the digital side? We see this huge excitement around ESG, KKR or CDC, and all the large funds and pension funds and Japanese funds are sort of pivoting to ESG, just transition, a whole lot of conversations and money and capital that is looking at those spaces. COP26 is talking about now not just large projects, but looking at climate resilience agriculture, looking at clean, sustainable agriculture. So big themes are emerging. We have just done an SDG 2 impact bond on agri and food security. So we are seeing a lot of large pools of capital. We're seeing a lot of new trends that are not microfinance baggage trends, but brand new trends, digital tech, clean energy. How do you see that as an opportunity for creating this ecosystem?
Sure. And actually, I just wanted to refer to the previous question as well, which you were speaking to, Royston. And I think report did highlight a few elements of that. Look, going sectoral, when you were speaking about ESG and getting sustainable impact financing into the sectors and what attracts investors, I think when you talk about NBFCs, I think it's very important and to understand that ultimately, while you want to create a pockets of finance across sectors, it's important that the loans disbursed has to come back, right? So it's very, very important to sectorally divide in a manner in which cash flows are trapped. So for example, we've launched now, like EV as a segment has really come up, right? And it's a part of the larger sustainability. We have gone to an extent of in our NBFC to understand the origination of the batteries, the movement of the electric vehicle, and the cash flows of the receivables in order to finance the entire ecosystem. So that's and any loan business, anything which is non-banking and you're trying to build a large loan book, I think similarly that cash flow trapping is very important to give comfort to the lenders and the investors for not only the generation of the IRR and the loans, but the return of the capital over a period of time. And similarly, I think 85% of the drivers in India, the truck drivers, do not get financed. So how do you partner with logistics companies to create a solution and trap the cash flow while getting them under the inclusion of finance? So I think every model, whether we touch upon healthcare, you mentioned about certain sectors, each and every sector can have its own use cases to build on the finance, to get people under the inclusion. At the same time, use the money where it's flowing is very important from any perspective, whether you're taking debt or equity, right? For the lenders or the equity investors to see the sustainability of the growth of those companies. And so that I just had that thought. I thought I'll express in terms of how it can be articulated in terms of what we see on ground in the new age. And similarly, and that's an extension of the answer what you raised on the new themes and how the private equity investors are chasing. I think, look, we've been hearing terms like Bharat and everything associated towards it. There are newer age companies. You're talking about tier 3, tier 4, and actually that's not only getting the impact money, that's not getting the private equity, that's also getting venture capital money, right? And I think that's that theme is also revolving around the same element, that how do you get deeper into the roots using either embedded finance or technology or cash flows, and anything which shows sustainability over a period of time to capture that mass, whether in individual or non-individual forms, will attract capital. The only thing which you have to unlock is to what extent this book will grow over a period of time. Does it have legs to reach to 1,000 or a 10,000 or beyond number? And I think there are a lot of differentiated business models within sustainability, within agri-tech, within other realms of financing, which has started coming up, which shows that power to build a significant book over a period of time. And talking about the funds you've mentioned, we work with some of them very closely. And I think that angle where the traditional NBFCs would not be able to cater to, the banks would not be able to cater to, that sectoral themes have started working well. And to name certain sector, I think we, for example, working with an equity fund, which is very focused on $1 billion of EV financing book over a period of time. And they are willing to do equity debt, both kind of structure. So I think that there will be those themes which will attract the future growth of India. And that's there to be looked upon.
Thanks for that sort of bullish look. Maybe I'll turn to the research person to give us, a little bit of centering and anchoring into also some of the things that we should watch out for. Some of the Impact NBFCs have a really recent, difficult patch. And so what are the lessons coming out of that? Because we don't want to let, the momentum and just, all these sort of pie in the sky only be attractive to us and lose sight of the real risks and pitfalls that could also be there. So maybe Deepti, based on your research that you've done, what could be those areas why Impact NBFCs have struggled? What should they watch out for as we get into this sort of new growth era?
Yeah, so Royston, I wouldn't say I'm an expert on tracking how the impact investing sector has gone about, has evolved, and kind of specific experiences that you're talking about. But I must say that the struggle is real, right? It's not something that we can wish away or plan for. For example, the pandemic was obviously a green swan. It's not something that risk management processes could have actually prepared for, whether for an NBFC or a bank. So really the Impact NBFCs, that the challenges are really, really real. And that just means that, it is, or rather the going is quite difficult. So I think that's where the role of the kind of government comes in, right? And it's not that there are new ideas to be placed here. One is, I think, what the CIBIL chairman talked about, which is really the partial credit guarantee scheme. Now, so far, historically, we've been doing refinance. So CIBIL, the other DFIs, NABARD, NHB, we've had refinance as a typical mainstream product. And for every rupee of refinance, you can only do an additional 1 rupee of new lending, right? But we are really talking of partial credit guarantees where that kind of leveraging is so much more impactful. The multiplier effect is, so I mean, even while CIBIL chairman did mention that this is something that they're looking into, and which I think UK MSME committee did point out. CIBIL is also, in a way, the CAG report of CIBIL also said that where is this is inadequate impact in terms of how CIBIL has, impacted MSME lives. So I think very quickly, two big, one is of course partial credit guarantee, very similar to how ADB participated in the microfinance sector, right? If it is in the MSME sector, what would that look like? And it's really, it's a straightforward product. People are really familiar with it. But CIBIL, I mean, in a way, it's also about sort of the incentive alignment to say that, yes, CIBIL may lose money at some point, because that's the role that the DFI here has to play, right? That we are truly taking risks and we are really supporting such entities to discover the new asset classes that they're trying to serve. And so it's not a bad thing if money is lost in the process. And so there is, I think that whole sort of patient capital, private impact money versus what the government can do. I think there are differences in just the features of both these kinds of capital. But clearly, I think certainly move away from a refinance as a strategy for sector building is a start. We should really think about how can we reimagine or rather just have these products even created in the first place. And I think very key, both in the case of priority sector lending, as well as in the case of, say, how CIBIL does its activities and monitors impact, we have to bring in a kind of impact lens, right? It could be geographical impact, it could be sectoral impact, but really having impact that is weighted towards underserved sectors and regions, rather than saying just somebody in BOP served is equal to impact. And I think RBI has actually made a very, very important first step towards that in the PSL regulations, where they've actually said we've kind of weighted districts across all kinds of parameters, and we've decided, okay, these are the underserved districts. So if you were to lend there for PSL, it becomes easier for you to achieve your target, rather than if you're lending in sectors or regions that have already been overserved, so to speak, right? And so how can we, so that's really an incentives-based system to drive impact and like bring back the focus on impact, because you have to demonstrate impact. And I think the SSC, I think all of the activities that are happening by on the side on creating the sources of exchange is really around, a significant part is about signaling impact, right? Measuring impact, having better ways to articulate that. And so I think a refocus, bringing back that it's not just about aspirational districts, but really what's the nature of impact that you're creating, and using that as a lens across many of these government sort of, historically significant schemes. Like priority sector has been there for over 50 years, and I think the other kind of important question is around NBFC, so PSL to last mile. I think the principle is that has credit being given to the last mile, whoever is considered is important from an equity point of view. It doesn't matter what the channel is, whether it's an NBFC MFI, whether it's anybody else. Why would the channel matter? As long as you have established without doubt that it has reached the deserve, like people who really need it according to PSL policy. So I think, so I think I would say that there are risks, and we have to kind of plan for it to the extent that we can. But there's so much that can be done towards bringing an impact, I think, framing to all of these schemes.
Thanks for that. I think we're maybe just in the last few minutes, I'm going to give you, a minute each to come up with, your one single action or suggestion that could really enable the ecosystem to be a lot more positive for the NBFC space. I want to give you a minute to think of it while I answer Ramraj's question, which he talked about why are lesser foundations, both international and Indian, really stepping up to the plate in terms of providing the type of support that they did, probably for the microfinance sector. And I think what we're seeing is the need to articulate more clearly. And I come back, repeatedly to Raman's point, what's the specific definition of an impact NBFC? And even over the last 3 hours, we've heard, people call it small NBFCs or small impact focused NBFCs and multiple sort of different descriptors. So we may need to come up with a term. It was very simple. In microfinance, it was called an NBFC MFI. And then that stuck. And then regulation opened up for that, PSL opened up for that, ECB opened up for that, and it's a new category. So maybe we want to spend a little more time, and I think IIC is well placed to do that, is to create that specific definition. And then, foundations will come in. They want to be sure that, it's catering to a certain segment. And the other is the regulatory environment. I think if we are able to get pools of capital, whether it is CSR money, and say, because it's catalytic in nature, it can survive or it can be categorized as a guarantee. I mean, that will unlock significant tens of thousands of crores if we are able to create pools of guarantee capacity. I mean, Deepti, you talked about, creating partial guarantees, credit enhancements, leverage. So if we can work with those themes in underserved geographies, underserved sectors, and build those pools out, I think the ability to build a link between CSR and SEBI in their social venture capital fund and RBI with priority sector lending, all of these together, I mean, in concert would make great music. But I'm going to turn to our three maestros and maybe take one quick suggestion and before I wrap up and hand it back to the IIC team. Nethra?
Yeah. I really think we've been speaking a lot about, capital, but I do think this the element of assistance beyond loans is an important piece. Ameya spoke about how there is definitely a lot of enthusiasm to look at climate as a theme, and how is it that they can address it. We have looked at a lot of companies where digitization is something, there is a willingness, but they obviously need that assistance in implementing it. So like that, and I know that there's financial literacy is something that I think a lot of the players in the ecosystem can really help in actually really driving impact. When we are not just talking about working with the NBFCs, but finally reaching to those customers.
Awesome.
And all of this will definitely help, whether it's scale or just be having a differentiated model.
Ishpreet, your 30 seconds, one suggestion.
Yeah, the fact, Royston, is that unfortunately, NBFC outstandings have gone low year on year comparatively to last year, and impact is in the same scope of lens. I think what we're talking about, the regulations might on capital requirements and other things might getting tougher only. So it's important to think out of the box and, as I said, create solutions which are not traditional in nature, and embrace tech or co-lend or do something sectoral which just enables you to have more weightage in the and relevance in the ecosystem.
Awesome. Deepti, your 30 seconds, one suggestion.
Yeah. So I'm going to be true to my profession and say data. So we just need a lot more data on just who are these entities. And when I say entities, we're talking of both large as well as small, like across the spectrum. We need that whole differential sense of what's happening in different parts of the spectrum of the NBFC ecosystem. And without that, I think we are just, searching in the darkness. We really need that kind of data, and I think sectoral, that kind of data collection is possible by the regulator, but also by a lot of the other DFIs, as well as third-party private organizations that can actually, and I think a corollary to that is that we want entities to start sharing data, right? Like, I think that's the other thing. Put out a lot of information proactively from a governance angle too, to say that, okay, I'm going to signal that I'm here I'm not hiding anything, I'm being transparent, and I want to contribute or be part of an honest ecosystem out there. So I think just having that kind of data, creating that is going to hugely contribute. Yeah.
Excellent. So, I think Ishpreet's point, I want to sort of resonate that point. It's going to get tougher for NBFCs on the regulatory side if we are able to create a separate impact NBFC carve out where the regulators, because it's meeting a broader SDG goal, because it's meeting a national agenda, is able to give a more supportive ecosystem. Then through data that will sort of build that narrative, and through technical assistance, it will support that growth. And then we can make sure that we are looking at what I like to call small NBFC, big impact. Over to you, Ramraj.